Ever wondered what ETFs are and how they can benefit your investment portfolio? Well, ETFs, or exchange-traded funds, have been making waves in the financial world. In the simplest terms, an ETF is a type of investment fund and exchange-traded product, traded on stock exchanges. ETFs are attractive as investments because of their low costs, tax efficiency, and stock-like features. They're a great way to dip your toes into the world of trading without needing to dive deep into the complexities of individual stocks. They're versatile, accessible, and have become a popular choice for individuals looking to broaden their investment horizons. So whether you're new to investing or a seasoned veteran, there's always something to learn about ETFs. Today, we're demystifying exchange-traded funds, or ETFs. Stay tuned as we delve into the nitty-gritty of ETFs, their benefits, how they work, and how you can incorporate them into your investment strategy. To understand ETFs, it's essential to know what they are. An exchange-traded fund, or ETF, is a type of investment fund and exchange-traded product. If you're wondering what that means, think of it as a basket. But instead of holding fruit or flowers, this basket holds different types of assets. These assets can be stocks, bonds, commodities, or a mix of these. Now imagine this basket is up for sale, not as a whole, but in parts. When you purchase a share of an ETF, you're essentially buying a piece of this basket. You're not buying the individual assets, but a fraction of the total collection of assets. This is what makes ETFs unique. It's like buying a little piece of the entire market or a specific sector of the market. But there's more to it. ETFs are designed to track the performance of a specific index. This could be a broad market index like the S&P 500 or a specific industry index like a technology or healthcare index. The goal of an ETF is to mimic the performance of the index it's tracking. If the index goes up, the ETF is expected to go up. If the index goes down, the ETF follows suit. This tracking is done by holding the same assets in the same proportions as the index. So if you invest in an ETF that tracks the S&P 500, you're essentially investing in the 500 companies that make up that index. But remember, while ETFs aim to track an index, there's no guarantee they will match it exactly. Factors such as fees, transaction costs, and the method of tracking can create what's known as a tracking error, causing a slight difference in performance. So why are ETFs popular? They offer diversification, which can reduce risk. They're also traded like stocks, meaning you can buy and sell shares throughout the day. This provides flexibility and control over your investment. By buying a share of an ETF, you're purchasing a small portion of a basket of assets. It's an accessible way to invest in a wide range of assets, all under one roof. Now that we know what an ETF is, let's discuss how it functions. Think of an ETF as a basket. This basket holds a variety of assets, stocks, bonds, commodities, depending on the type of ETF. When you buy a share of an ETF, you're essentially buying a small piece of everything in that basket. This is what gives ETFs their diversification advantage. Instead of putting all your eggs in one basket, you're spreading them across many. The contents of the ETF basket are not chosen at random. Instead, most ETFs aim to replicate a specific index, like the S&P 500 or the NASDAQ 100. This means the ETF holds the same assets in the same proportions as its target index. So when you invest in an ETF, you're essentially investing in the performance of its underlying index. Now here's where ETFs start to look a bit more like stocks. Unlike mutual funds, which only trade at the end of the day at their net asset value, ETFs can be bought and sold throughout the day like stocks. Their prices fluctuate based on supply and demand in the market. If more people want to buy the ETF than sell it, the price goes up. If more people want to sell the ETF than buy it, the price goes down. This real-time trading makes ETFs more flexible than mutual funds. If you see an opportunity to buy or sell at a particular price during the day, you can do so with an ETF. However, it's important to remember that while this increased flexibility can be beneficial, it can also add complexity. You'll need to consider factors like bid-ask spreads and trading commissions, just as you would with stocks. In conclusion, ETFs offer a unique blend of features from both mutual funds and stocks. They provide the diversification and index tracking benefits of mutual funds, while also offering the real-time trading capabilities of stocks. ETFs combine the diversification of mutual funds with the ease of trading a stock. Many investors question the difference between an ETF and a stock. At first glance, they may seem similar as both are traded on an exchange and represent a piece of ownership. However, the similarities largely stop there. Let's start with stocks. When you buy a share of a company's stock, you're buying a piece of that company. Your profit or loss is tied directly to that company's performance. This can lead to high rewards if the company does well, but it also means high risk. If the company's performance falters, your investment could take a hit. On the other hand, an ETF is like buying a little piece of a whole sector, industry, or index. Instead of placing all your bets on one company, an ETF spreads your investment across many companies. This provides a level of diversification that can help safeguard against the volatility of the stock market. For instance, if one company within the ETF underperforms, it could be balanced out by other companies that are doing well. However, this diversification also means that ETFs may not offer the same potential for high returns as individual stocks. If you invest in a single stock and that company does exceptionally well, your returns could be substantial. In contrast, the diversification of an ETF means you're less likely to see such dramatic swings, up or down. Another difference to consider is the level of management. Stocks are a hands-on investment. You need to research and choose each individual stock and monitor their performance. ETFs, meanwhile, offer a more hands-off approach. They're professionally managed and designed to track a specific index or sector, so you don't need to do the legwork of picking individual stocks. In conclusion, the choice between investing in an ETF or a stock isn't a one-size-fits-all answer. It depends on your risk tolerance, investment goals, and how much time and knowledge you have for managing your investments. Choosing between an ETF and a stock depends on your investment goals. If you're new to investing, ETFs can be a great starting point. They provide an excellent opportunity to dip your toes into the investing world without the need for extensive market knowledge or a hefty initial investment. ETFs allow you to buy a small part of a diversified portfolio, which means you're not putting all your eggs in one basket. This diversification reduces the risk of losing your investment if one company or sector underperforms. Moreover, ETFs are traded like stocks, which means you can buy and sell shares throughout the trading day, providing flexibility. They're also transparent, as most ETFs disclose their holdings daily, so you'll know exactly what you're investing in. Finally, ETFs provide an easy way to gain exposure to various sectors, countries, or investment strategies, allowing you to align your investments with your interests, beliefs, or predictions about market trends. They're less risky than individual stocks, don't require extensive market knowledge, and allow for diversification with a single transaction. A common question amongst investors is whether ETFs pay dividends. Well, the straightforward answer is yes, many ETFs do indeed pay dividends. Here's how it works. If the ETF you've invested in holds dividend-paying stocks, the income from these dividends is usually accumulated and then paid out to the ETF shareholders. This could be you. These payments can come on a regular basis, often quarterly, but it's not a set rule. It depends on the specific ETF and its underlying assets. Now remember, not all ETFs are created equal. Some might choose to reinvest the dividends, which can lead to an increase in the overall value of the ETF. So while you might not receive a dividend payout per se, you could potentially benefit from the increased value of your investment. In conclusion, many ETFs pay dividends, but the frequency and amount can vary based on the ETF's policy. Scene 7. Investing in ETFs. Investing in ETFs is a straightforward process. It's akin to a journey, beginning with setting up the vehicle for your investment journey, a brokerage account. This is your gateway to the world of ETFs, allowing you to buy and sell these funds just like individual stocks. You can choose from various online platforms, each offering unique features and fee structures. Once you've set up your brokerage account, it's time to embark on the exciting part, selecting your ETFs. This is where the world becomes your oyster. ETFs span across a vast array of sectors and industries, each one presenting a different opportunity and risk level. Some ETFs focus on technology, others on healthcare or finance, and there are even those that track commodities or international markets. The choice is yours, based on your investment goals and risk tolerance. But how do you choose from the sea of options? Well, research is your compass. Delving into the performance history of an ETF can give you insights into its past successes and challenges. Keep in mind, though, that past performance is not a guarantee of future results. It's just one piece of the puzzle. Another crucial factor to consider is the fees associated with the ETF. These can eat into your returns over time, so it's important to understand them up front. Some ETFs have low expense ratios while others may be higher. This is often a reflection of the management involved in the fund, with actively managed funds typically carrying higher fees than their passively managed counterparts. In addition to fees and performance, you might also want to look at the sectors the ETF covers. This can help you diversify your portfolio and spread out your risk. For instance, if you already have heavy exposure to technology stocks, you might consider an ETF that focuses on a different sector to balance things out. In conclusion, investing in ETFs is not just about buying shares and hoping for the best. It's a strategic process that requires research and consideration. It's important to research different ETFs, considering factors like the sectors they cover, performance history, and associated fees. ETFs offer a variety of investment options. They cover a broad spectrum of sectors, giving you the freedom to invest in the industries that you believe in or have faith in their growth potential. Let's look at some examples. For tech enthusiasts, there are technology ETFs that hold shares of tech companies. These ETFs let you invest in the whole tech sector without needing to pick individual stocks. Similarly, if you're optimistic about the healthcare industry's future, healthcare ETFs might be your cup of tea. They hold shares of various healthcare and pharmaceutical companies. Finance ETFs are another popular choice, which invest in banks, insurance companies, and other financial institutions. These ETFs provide an easy way to tap into the finance sector's potential gains without the need to understand the intricacies of each financial institution. But the variety doesn't stop at sectors. There are different types of ETFs that cater to various investment strategies. For example, bond ETFs invest in bonds instead of stocks, providing regular income and lower risk compared to stock ETFs. These can be a good choice for conservative investors looking for steady income. On the other hand, commodity ETFs allow investors to invest in physical commodities like gold, oil, or agricultural goods. They offer a way to diversify your portfolio and hedge against inflation. And let's not forget about international ETFs. These funds invest in companies located outside your home country, offering a simple way to diversify your portfolio geographically and gain exposure to foreign markets. In summary, ETFs offer a smorgasbord of choices to investors. Whether you're interested in a specific sector, looking for income, or wanting to diversify your portfolio, there's likely an ETF that fits your needs. There are also bond ETFs, commodity ETFs, and international ETFs catering to diverse investment strategies. Several key players manage ETFs. These powerhouses in the investment world have made it possible for investors to tap into a wide array of market sectors. BlackRock's iShares is a titan in the industry, boasting a portfolio of over 800 ETFs. They offer solutions for various investment goals, whether you're focused on income, growth, or sustainability. Then there's Vanguard, a pioneer in low-cost investing. Their ETF lineup covers a comprehensive range of asset classes, sectors, and styles, making it a favorite among cost-conscious investors. State Street Global Advisors, the creator of the first-ever ETF, continues to innovate with a robust selection of ETFs, including the popular Spider series. Not to be overlooked is Invesco, known for their QQQ ETF that tracks the Nasdaq 100 index, a favorite among tech-focused investors. Each offers a range of ETFs, catering to different investment objectives and strategies. To wrap up our discussion on ETFs, let's do a quick recap. We've discovered that exchange-traded funds, or ETFs, are an accessible and versatile investment tool. They offer the benefit of diversification, similar to mutual funds, with the convenience and flexibility of trading like stocks. This makes them an attractive choice for both beginners and seasoned investors. We've also learned that many ETFs do pay dividends, further enhancing their appeal. To invest in ETFs, all you need is a brokerage account, opening up a world of opportunities to invest in various sectors, from technology to healthcare and beyond. Remember, the big players in ETF management like BlackRock's iShares, Vanguard, and Invesco offer a broad range of ETFs to cater to different investment strategies. As we journey through the world of investing, remember that ETFs can be a powerful tool in your arsenal. But as with any investment, it's crucial to do thorough research and consider your long-term financial goals.